Hey traders, welcome to another episode of Charts and Coffee. Happy Thursday, everybody. It's going to be a pretty interesting day as we are looking at the calendar waiting for 12:05 p.m. and Jerome Powell has a Q&A, some kind of gig event he's doing with the Wall Street Journal, and it's the last time before we get to the actual Fed meeting. 13 days that we'll probably hear from him maybe at length or maybe at all. So what's on the agenda? Well, yesterday we saw it happen, and that was the mention of Operation Twist 3. What does that even mean? We'll talk a little bit about that here today. Of course, take your questions. And just a reminder that anytime Jerome Powell is on the calendar, it's going to be a caution day. Again, I really expected the market to be a little bit more bullish yesterday in terms of its reaction to going into an event we saw mid-morning yesterday when the rumor of a potential Operation Twist 3 hit. Now, a lot of folks say, well, where did that come from and why is that even potentially legitimate? The source of the rumor is an analyst at Bank of America. I think his last name is Cabana. He used to be a staffer for the New York Fed, and a lot of folks still feel he has the ear of the New York Fed or at least some influence. And then when you look at the logic behind what it would mean, what is an Operation Twist? It's quite visually affecting the yield curves. So what you do is you sell the longer dated bonds and you buy the longer dated bonds and you sell the shorter dated. So again, you're buying the 30-year, even maybe the 10. We'll see what they want to do. But you're selling the shorter term. And what that does is it sends the yields higher, shorter term, sends the yields lower, longer term. Now, to make this all even more confusing, remember that the direction of the bond market, if you're looking at the ZB 30-year futures, the direction of bonds is inverse to the yield. So when bonds head lower, the percentage, the yield is actually higher. That's it. That's where we're at. And the other question I received a lot is why now in terms of bonds? Remember that it's not the downtrend in bonds that's troubling. It's actually the fact that we've reached a certain yield. And once we reach a certain yield, usually one that rivals dividend yielding stocks, that often creates this selling of stocks, buying of bonds. So it's not just the downtrend in bonds. It's the spread oftentimes, and it's going to be the yield, which we know that the level now was crossing through 1.5. That's when it sparked the kind of weakness that we started to see. All right, so that's where we're at. And I have a breakdown of that in the free video yesterday, Simpler Trading's free video for the futures. I do that every night, and I kind of broke this down yesterday as well if you want to get a little bit more insight into that. Okay, so as always, let's see. First question. Let's take some Q&A here. And first up is, good morning. I like your thoughts on Johnson & Johnson and Spot this morning. Sure. Okay, so we have to talk about XLV if we're going to talk about Johnson & Johnson. And, partially, here's where, for example, I'm still buying pullbacks. And when I look back on what I've been doing, say the last 10 days since things have gotten pretty choppy and volatile, I'm probably being a little too aggressive just because I'm comfortable scaling in with a little bit of size at an aggro level, a little bit more size at a moderate, and putting in the bulk of my position at a conservative level, which is closer to the validity of the trade. I can be wrong, but it's pretty close to where the trade is no longer valid. Lower risk in that regard. Lower risk control based on how and where you're positioning, size and level in the market. But all of those are in markets that preferably have a sector that's moving higher, double green, and the individual stock moving with that sector. That's that boats and tide. The boat is the stock, the tide is the larger sector. Even it could be at the index sector level. Index is moving higher, sector is moving with it. In this case, is the sector moving higher, and it's the stock moving with it. And I don't have either one of those situations in Johnson & Johnson. So I'd leave XLV, J&J alone unless there's a relative outperformer still within the XLV. I know AbbVie's been holding its own. Lilly had my attention some time ago. See, Lilly would be, okay, here you go. Lilly would be, Aircon Gypsy, that would be a relative outperformer. So, and that's actually one I should probably look at. So I haven't done a lot with healthcare because you look at XLV. This was on my list about a week ago. I don't want to do much with XLV, generally speaking, broadly, but maybe individually getting more granular and chop makes a lot of sense. All right. So then spot. No, again, same thing. I don't want to deal with chop. Now, if we end up losing trend after trend after trend, I can't recall ever a market where there's not some sort of trend intact. Because when other markets are getting choppy, like you notice, I think there's an exodus from the likes of tech into financials. So there's always going to be something that's going to benefit from something else being sold off. Money doesn't end up under the mattress. So we remember the flow. If one's flowing out, that means it's going to go somewhere. I think it's almost like a scale. And so that's what I would keep in mind. Additionally, when it comes to spot, let's say you do want to trade chop. Nothing wrong with it. This is distribution. This is Charles Dow distribution. When you have a distribution market, ideally you find a level at which you have volume support, you have good timing to some sort of event that might be a catalyst for movement upside. You don't always have that. You want support by way of price. So maybe it's Darvis, maybe it's a volume profile level. Maybe it's an exponential moving average, like a 200 or some kind of moving average. Maybe it's a prior low. We saw gold have a technical bounce, not for very long, but it was just a quick little trade because it had a technical bounce off a prior low from November. So I'd like to see something like that. What could be interesting here is that level there, that high. There's a Darvis. That could be an interesting level. And that would be just a technical bounce. Technical bounces are valid, not in downtrends, but in choppy distribution markets, which is what spot's in. So I hope that helps in terms of perspective. There you go. All right. What's my thought on BA? Hey there, Patrick. BA, Boeing. So I know Boeing's been getting a lot of attention, but I think it kind of goes back to the way that we broke down Johnson & Johnson earlier. Is Boeing, of all the stocks within the, if you're looking at the IYT, or if you're looking at XLI, or if you're even looking at DIA, is Boeing the best in terms of uptrends? And I think when you break that down, much like we just did with Johnson & Johnson, look at the heavily weighted stocks, look who Boeing's hanging around with. That's what Sector Secrets is all about. When I talk about it's not a secret at all. How do you look at the broader group, right? The markets group this stuff up for us, right? By way of index, by way of these ETFs and these niches and these sectors. We already know that these are grouped together and part of an ETF. That's why it's really important that you focus on ETFs that have higher volume, that's more influence on the underlying stocks, right? So I can't say that when I look back, Boeing is that relative outperformer. I don't want to short it per se, but I don't find it to be really, what does Boeing have going for it? It does have some things going forward. It's real recently started to move higher off the wave. It's trading above its 200 exponential moving average. And Boeing, of course, is part of an overall tide that's been much more resilient in the current chop. That means I'm talking specifically the Dow. So you think about the Dow, broad index, then you think about the individual sectors, transports, XLI. You also can think about where Boeing is within the ITA. And that's where I'd say do the comparison. But Boeing's not bad. I just think there are better choices that could be relative outperformers compared to Boeing. Thank you for the question, though. I sure don't want to short it. I just want to find things that are doing things like it, but better, right? Okay. Hey there, Kim. Time to take profit on DKNG. I'm a long-term holder, but want to protect some gains. So when you're in a market, I mean, to me, swing highs, you don't need a lot of technical expertise. They pop out at you really easy. Darvis levels will typically accompany swing highs and minor highs, swing lows and minor lows. That's why I love Darvis. Think about this. Darvis is actually a process-based support and resistance level tool that looks at where the market actually did stop and reverse before, based on that process of a minor high and a candle count. Again, Nicholas Darvis, and this is something from the late 50s, so definitely time tested, right? The idea that if I buy pullbacks, I should expect the market to take out a recent minor high. To me, that's a low probability, or at least a risky bet to gamble. So, if you're looking at now, you can almost treat this as a trailing stop, Kim, which is if we dip back down below, say 64.60, even 64.50, go ahead and scale out. But on the way up, that would be a level, that swing high would be a level that I would keep an eye on. That's 64.65, that area. What was this high? I'll tell you exactly what it was. 64.78. There you go. So in that area, on the way up, I would have said take profit into that swing high. Now we're coming back down to test it. But yeah, unless we start to really crush that level, you can let it run at this point. You were able to take out the swing high. So we're pulling back pretty dramatically, but we are getting a little bit of support by way of the February VWAP, which I'm going to re-anchor today. We're getting a little bit of support by way of the previous high. I would say shorten your time frame. Look for some volume levels and look for an intraday trend. Maybe it's a 15-minute, maybe it's a 1 hour that you can use to manage your position to scale out. I wouldn't get flat, but yeah, it certainly wouldn't hurt to scale out and pay yourself, right? And then here's the most important part of that. Move the stop to break even, right? Can we take a look at corn? Yes, that's actually a trade that I've been talking about both in the free and premium videos for simpler futures. Heck, we've been talking about that in Sector Secrets because we have the CORN ETF that we can trade. I like corn to the long side. And so, yeah, I'm interested in corn because, again, in a reflation market, I'm looking for commodities to move higher. So if I've got a market like corn, I would throw beans in there. I'm also looking at hogs. We've been buying cattle. Now I'm focusing on hogs. Commodities, and I call these grocery store commodities because futures, unfortunately, usually get limited to this very small pool of indices. I'm a futures trader. It means usually for most people, I trade the S&P, which is fine. It is a futures contract. But aside from the interest rate markets and the currency markets and the indices, you've got then the tangible goods. I call them the grocery store commodities, copper and corn and cattle, and I'm definitely rocking the alliteration there. But the things that we buy, the goods that a lot of companies use to do what they do, right? So don't neglect those. And I love that you're asking about it. So thank you very, very much, Nick. So yes, I like corn to the long side. We like beans to the long side. And I'm also keeping an eye on hogs right now, in addition to our existing position in cattle. So thank you for that. Hang on, let me get to the next question here. And let's see. Abe, how you doing, Abe? S&P and that. Yeah, pajama traders, overnight traders, and that's not a disparaging term. The liquidity and the participation once the U.S. markets close into the NASDAQ, Russell, Dow, and S&P is very different. The price movement ranges contract, the volume drops, and who is trading the market is very, very different. So when I'm looking at the kind of mood that the Asian session is in, I start looking at the Nikkei. When I look at the kind of mood that the European and the UK sessions are in, I'll look at the FTSE, I'll look at the CAC 40, I'll look at the markets that are local to the financial centers that are open. And a lot of times we inherit that mood, right? You want to know how the Hang Seng closed. You want to know how the Asian markets, the Nikkei closed. You want to know how the markets in Europe and the UK closed. And a lot of times we'll inherit that sentiment. So I don't look at the U.S. markets as really being the U.S. markets until 7 a.m. At 7 a.m., I'll say, all right, that's the first cup of coffee. And one of my first mentors used to say, hey, Rog, that's sort of when they wake up in the morning, 7 a.m. New York time, East Coast. And that's when I'll start to say, okay, now the U.S. is starting to, we'll see that the volatility, the price movement ranges increase, the volume starts to increase. So that's when I'll start to say, all right, this is now, the ball is in the U.S.'s court. Up until that point, we're in many ways surfing the sentiment of other financial centers. So yeah, if you're going to see a shift, clearly we can see another shift at the bell, right? That's a whole other thing. But right now, yeah, we can definitely see that since 7, we've been moving higher. Which, remember that with Powell speaking today, gang, normally, and this has been a very volatile market for any number of reasons. We're still waiting on the stimulus. And then now we've got this extra added bond narrative. You can see here, this is the 12:05 p.m. Powell event. This is an online event hosted by the Wall Street Journal. And I will tell you this about Jerome Powell, because we experienced this early in his tenure as Fed chair. When he created the V-bottom in 2019, he did so not in a Fed meeting, not by way of a Fed statement, not by way of even any kind of formal Fed event. He did it in this Bloomberg televised, it may have been televised, but it was a Bloomberg event with 2 previous Fed chairs. I think he was sitting on a stage with whomever from Bloomberg was interviewing him, Janet Yellen, and I believe it was Ben Bernanke. And in that, he actually communicated that the Federal Reserve was going to stop hiking rates. You guys might remember that late. We were hiking. The market was freaking out. Those were all the tantrums. And so the reason I bring that up is he does have a history of communicating to the market what I would think are pretty important monetary policy shifts, but not in that formal setting, sometimes in informal settings. This, to me, is reminding me of when he did that in Bloomberg. It was a Bloomberg interview. Now it's an online Wall Street Journal. So if he's going to start to prepare the markets for Operation Twist, and by the way, if you noticed, I believe it was Evans and Harker's comments yesterday going into the close, they were actually definitely laying a at least clearing the path for the market to not be shocked by something that he would mention along those lines, buying the longer end of the yield curve, selling the shorter end of the yield curve, and creating that twist. So I think that it would solve a lot of problems. It would solve the short-term yield problem. It would solve the longer-term yield problem. They have problems at both ends of the yield curve, and twist in many ways is like QE light, but it allows printing and a lot of it. So heads up, it's 12:05 today Eastern, and if he announces that, financials will continue to move higher, I believe, but we will see, I think, the market take that as a very strong positive. All right, next up, why would Operation Twist be bullish for stocks? For all the reasons that I mentioned. If we're right now, yeah, exactly, Operation Twist, why would it be bullish for stocks? It's more printing. Yeah, Seth, it's definitely, it's more printing. And if the market right now is freaking out because the yield curve is tempting. So again, go back to what we mentioned before, which is if dividend yielding stocks and bonds are now competitive in terms of return, in terms of that yield, all of a sudden you'll see the market move out of equity sometimes and into bonds. We've seen that a little bit, or at least there's that concern. That's the threshold. That's the threshold. The bigger concern, though, is the Federal Reserve has been, I don't want to use manipulating in any insidious way. They've been manipulating the longer end of the yield curve to keep it low. It discourages savings. It encourages home buying, home projects. It encourages auto sales. It encourages spending. It discourages saving. They need to keep that longer end of the yield curve in control. And what happened last week, is that the bond market said, you are underestimating inflation. You do not have control of the longer end of the yield curve. And that created this clash of the titans. And Jerome Powell has to come out soon and say my bazooka's bigger. Bond market, I hear you, but we've got this under control. When that message is seen by way of price action, the equity markets will start to rally again. So that's really it. And just like that, I am out of time. So thank you for the questions, gang. Good stuff. Alvaro, I see your question about copper. I'm very bullish copper. We've talked about copper a lot in Charts and Coffee. Copper and platinum. I'm not interested in gold. Copper, platinum, silver, and in that order. Okay. All right. Wrap it up there. I'll see you guys tomorrow. We'll be right back at 9 a.m. I'm going to head on over to the futures room. If you're a part of one of our simpler masteries or one of our trading rooms, all the fun's kicking off now. And if you're not, check out one of the trials. Come join us for a month and trade alongside of us. We got a great community here in Simpler Trading. I'll talk with you all soon. Be good to each other.